Hi friends, in this module we will discuss on chapter 3 admission of a partner, question number 21 to question number 25. First we will go to question number 21. Partners A, B and C share profits of the business in the ratio of 3:2:1 respectively. For 1/6 share they admit D, who brings in rupees 2 lakhs including 60,000 of his share of goodwill. Show journal entries if A, B, C and D decided to share the profit respectively in the ratio of A 15:10:5:6, B 5:3:2:2, C 2:2:1:1. Assume the entire cash brought in by D remains in the business. Give journal entries. Okay, so in this question we have three partners. Okay. A, B, C. They share profit in the ratio of 3:2:1. D was admitted as a new partner for 1/6 share of profit and he brings 1,40,000. As his capital, because here in the question they say 2 lakhs is the total amount that he bought in. Out of that 60,000 is his share of goodwill. So 2 lakh minus 60,000, 1,40,000 is his share of capital. Then he bought 60,000 rupees as his share of goodwill. So this is capital and this is goodwill. There is first scenario where the partners, including the new partner, decided to share the profit in the ratio of 15:10:5:6. So in this one we will have first journal entry, which is bank account debit. He bought in 1,40,000 as capital and 60,000 as goodwill, so it is 2 lakh. To the new partner's capital, so to D's capital, which is 1,40,000, and to premium on goodwill, which is 60,000. Next we need to divide the goodwill in old partner sacrificing ratio. So we have premium on goodwill debit 60,000. Then we have to A's capital, to B's capital, to C's capital. In order to find the exact amount that has to be credited to each of these partners' capital account, we need to find the sacrificing ratio. So let's find the sacrificing ratio here. For A, his original share is 3/6. Now his new share is 15/36 here, which will give 3/36. Now we have B, his original share is 2/6 minus his new share, which is 10/36, which is equal to 2/36. Then we have C, his original share is 1/6 minus his new share 5/36, which is equal to 1/36. So the sacrificing ratio between A, B and C is 3:2:1. So we can divide the 60,000 rupees in 3:2:1 ratio, which will be 30,000, 20,000 and 10,000. So that's the first scenario. Then we have a second scenario. The question says, if the partners decide to share profit and losses in the ratio of 5:3:2:2. So in the scenario, we need to find the sacrificing ratio. So for A, the existing share is 3/6 minus his new share, which is 5/12. So 5 plus 3 plus 2 plus 2, it's 12. So 5/12, which is equal to 6 minus 5/12, which is equal to 1/12. Then we have B. His original share is 2/6 minus his new share, which is 3/12. That is equal to 4 minus 3/12, which is equal to 1/12. Then we have C. His original share is 1/6 minus his new share, which is 2/12. That is equal to 2 minus 2/12. That is equal to 0/12, which means he didn't do any sacrifice. The sacrificing ratio between A and B is 1:1. So here C is not sacrificing anything. This is the sacrificing ratio. Now we need to look for journal entries. First journal entry is the new partner is bringing in capital and goodwill. So bank account debit 2 lakhs to D's capital 1,40,000 and to premium on goodwill 60,000. Then the second journal entry is to divide this premium on goodwill between the partners who sacrificed. Here in this case it is A and B. So premium on goodwill debit 60,000 to A's capital to B's capital. Now we know that the sacrificing ratio is 1:1. So it's going to be 30,000 and 30,000. Then we have our third scenario. So third scenario is if the partners decide to share profit and losses in the ratio of 2:1:1. So in this case for A, the original share was 3/6 and the new share is minus 2/6. That will give 1/6. Then for B, the original share is 2/6 minus 2/6, which is a new share, that is 0/6. Then C, we have 1/6 minus the new share 1/6, which is 0/6. So in this case only A sacrificed. So the entire goodwill that is bought in by the new partner belongs to A. So let's look at the journal entries. First journal entry is bringing in the cash. So bank account debit 2 lakhs to D's capital 1,40,000 to premium on goodwill 60,000. Then we need to divide the goodwill to the partners who sacrificed. In this case, it's only A. So premium on goodwill account debit 60,000 to S capital 60,000. Okay. Now we will move on to question number 22A. P and Q are partners sharing profits in the ratio of 7:5. They admit R into partnership for 1/4 share who pays ₹30,000 in cash for goodwill. P and Q decide to share future profits equally among themselves. Past journal entries. So here we have two partners, P and Q. Their profit sharing ratio is 7:5. They admitted a new partner R for 1/4 share of profit and he bought 30,000 as goodwill. So first we wanted to find the remaining profit after giving our share of profit. So the remaining profit is equal to, assume the total profit of the firm is 1 minus our share of profit 1/4, that is equal to 4 minus 1/4, which is equal to 3/4. Now we wanted to find the new ratio. So new ratio for P is going to be the remaining share of profit 3/4 into, they said they are going to share the new profits equally. Okay, P and Q decide to share future profits equally. So that means 1:1. So it is 1/2. That is equal to 3/8. Then we have Q. The remaining profit is 3/4 multiplied by 1/2. That is equal to 3/8. Okay. So what's the new profit sharing ratio? So we have R also, it's 1/4. So if we wanted to have a common denominator, it's going to be 2/8. So the new profit sharing ratio between P, Q and R is equal to 3:3:2. So what's the sacrificing ratio of these partners? We also wanted to understand the sacrificing ratio. So we have the new profit sharing ratio. Sacrificing ratio is basically is equal to original share of profit minus new share of profit. So for P, his original share is 7/12, 7:5, so it is 7/12 minus his new share, which is 3/8. That is equal to 56 minus 36/96. That is equal to 20/96. Then we have Q. His original share was 5/12 minus his new share, which is 3/8. That is equal to 40 minus 36/96. That is equal to 4/96. So sacrificing ratio between P and Q is 20:4. If we simplify it, it is going to be 5:1. So we have the sacrificing ratio as well. Now we need to pass the journal entries. Okay, first journal entry is bringing in the goodwill. So it's going to be bank account debit 30,000 to premium on goodwill, that is 30,000. Now this premium on goodwill has to be divided among the partners in sacrificing ratio. So premium on goodwill account debit 30,000 to P's capital to Q's capital, and this has to be divided in sacrificing ratio, which is 5:1. So it's going to be 25,000 and 5,000. Okay, now let's move on to question number 22D. X and Y are partners sharing profits in the ratio of 2:1. They agree to admit Z into partnership, who gets 1/3 share in the profits. Z brings rupees 50,000 for his capital and the necessary amount of goodwill in cash. Goodwill of the firm is valued at rupees 36,000. X, Y and Z agrees to share future profits equally. The amount of goodwill is withdrawn from the business. Past journal entries. Okay. So here we have two partners, X and Y. They share profits in the ratio of 2:1, and they admitted a new partner Z. Z is admitted for 1/3 share of profit, and he bought 50,000 as his capital. He also bought his share of goodwill that we need to calculate. So it's yet to be found. Okay, so the question says goodwill of the firm. Goodwill of the firm is 36,000. We have X, Y and Z, and their new profit sharing ratio will be 1:1:1. So goodwill bought by Z. Goodwill of the firm 36,000. Now his share of goodwill, 1 plus 1 plus 1 is 3, so into 1/3. So his share of goodwill should be 12,000. So ideally he should bring 12,000 rupees as goodwill. So we now got Z's share of goodwill, which is 12,000. Now we need to find the sacrificing ratio. So here X original share is 2/3 minus his new share, which is 1/3. That is equal to 1/3. Y's original share, it's 1/3 minus his new share 1/3. So it's 0/3. He is not making any sacrifice. Here only one person sacrifice is made by X only. Then we need to pass the journal entries here. First journal entry is 36,000 rupees is bought in, right? So it is going to be bank account debit 36,000 to Z's capital. So he bought in some capital, which is 50,000. And he also bought goodwill, which we calculated, which is 36,000. Sorry, it is 12,000. $12,000 is here. This is the goodwill that is bought by Z. So 50,000 plus 12,000, it is 62,000. It's a first journal entry. Then we have this goodwill that is bought by D has to be given to the sacrificing partners. So in this case, there is only one sacrificing partner, which is X. So goodwill, which is 12,000, that is debited to X capital, 12,000. Then the question also says goodwill is withdrawn from the firm. So X capital account debit, 12,000 to bank, 12,000. Okay, so that's the answer for question number 22B. Let's move on to question number 23. A and B are partners sharing profits and losses as 2:1. On 1st April 2016, they admit C as a partner for 1/4 share who pays rupees 4,50,000 as goodwill privately. So we have to remember this word privately. Privately means that we need not account for it because it is settled outside the business. On 1st April 2017, they take D as a partner for 3/5 share who brings rupees 4 lakh as goodwill, out of which half is withdrawn by existing partners. On 1st April 2018, E is admitted as a partner for 1/6 share who brings rupees 5 lakh as goodwill, which is retained in the business. Generalize the above transactions in the books of the firm. Okay, so we have A and B as partners and their profit sharing ratio is 2:1. They admitted C in the partnership for 1/4 share of profit and he bought 4,50,000 rupees as goodwill, but it was done privately, which means that we need not account for it. Later, D was admitted in the firm for 3/5 share of profit and he bought 4 lakh rupees as his share of goodwill and half of it is withdrawn. Then later E was admitted in the partnership for 1/6 share of profit, out for which he bought 5 lakh rupees as goodwill and it was retained in the business. So each of this new admission happened in different years. In one in 2016, this in 2017, and this happened in 2018. Okay, so first we are going to discuss on 2016. So in 2016, C was admitted for 1/4 share of profit. So now we wanted to find the remaining share of profit. Assume that the total profit of the firm is 1 minus profit given to C, which is 1/4. That will give you 3/4 as the remaining share of profit. Now A, the remaining share of profit 3/4 multiplied by his original share, which is 2/3, that gives 6/12. Then we have B, remaining share of profit, which is 3/4 multiplied by his original share, which is 1/3, that will give 3/12. And then we have C, 1/4 is his share of profit, which is given in the question. If we wanted to have same denominator, it's going to be 3/12. So the new profit sharing ratio between A, B and C is 6:3:3, that is equal to 2:1:1. So that's the new profit sharing ratio in 2016. Now we will move to 2017. In 2017, we have these three partners in the firm, A, B, C, and their profit sharing ratio is 2:1:1. So we wanted to calculate the remaining profit when D is admitted. So assume that the total profit of the firm is 1 and D is admitted for 3/5 share of profit, which means that the remaining share of profit is 2/5. Now we wanted to calculate each of the partners' share. For A, the remaining share of profit 2/5 multiplied by his original share. Original share means the share that we arrived at in 2016. 2:1:1. That means it is 2/4. 2/5 into 2/4 is equal to 4/20. Then we have B. Remaining share 2/5 into his original share in the beginning of 2017, which is 1/4. That is equal to 2/20. Then we have C. Remaining share of profit, which is 2/5 into 1/4, which is his original share, that is equal to 2/20 again. Then we have D. His share of profit is given in the question, which is 3/5. If you wanted to have the same denominator, it's going to be 12/20. So the new profit sharing ratio between A, B, C and D, A, B, C and D is 4:2:2:12, which is 2:1:1:6. That's the new profit sharing ratio. Now let's move on to 2018. In 2018, we have the existing partners. The existing partners is A, B, C and D, and their profit sharing ratio is 2:1:6. Now in 2018, we wanted to find the remaining profit after admitting the new partner E. So remaining profit, assume that the total profit of the firm is 1 minus the profit share that is given to E, which is 1/6. That is equal to 5/6. Now for each of the partners, for A, it is 5/6 multiplied by 2/10, that is equal to 10/60. Then we have B, it is 5/6 multiplied by 1/10, that is equal to 5/60. Then we have C, 5/6 multiplied by 1/10, that is equal to 5/60. Then we have D, which is remaining share 5/6 multiplied by his original share in the firm at the beginning of the year, which is 6/10, which is equal to 30/60. Then we have E. He has 1/6 share in the new profit, that is, if we have wanted to have the same denominator, it is 10/60. So the new profit sharing ratio between A, B, C, D and E is equal to 10:5:5:30:10. If you simplify it, it's going to be 2:1:1:6:2. So this is the new profit sharing ratio in 2018. Okay, now we need to also pass the journal entries for each of this year. So first year in 2016, what's happening is the new partner, Mr. C, is bringing goodwill of 4,50,000, but it is bought privately, which means that we need not account for this. And in 2017, goodwill is bought, which is 4 lakhs. So and half of it is withdrawn. So we need to pass journal entries for 2017. So first journal entry is bringing in the goodwill. So that means bank account debit 4 lakhs. This is all happening in 2017. To goodwill 4 lakhs. then this goodwill has to be divided among the partners in their sacrificing ratio. So goodwill account debit to A's capital, to B's capital, to C's capital. So here their sacrificing ratio is the original profit sharing ratio itself, 2:1:1. So if we wanted to divide 4 lakhs in 2:1:1 ratio, it's going to be 2 lakhs, 1 lakh and 1 lakh. Now then the question says that half of the goodwill is withdrawn by the partners. So partners capital account has to be debited. A's capital account debit, B's capital account debit, C's capital account debit. Half of 2 lakh is 1 lakh. Half of 1 lakh, 50,000. Again half of 1 lakh, 50,000. So it is withdrawn. So credit item is to bank. It's 2 lakhs. Then 2017 things are over. In 2018 they say that E is bringing goodwill of 5 lakhs and it is retained in the business. Okay, so we need to pass journal entries for that. First thing is bank account debit 5 lakhs. This is happening in 2018. 2E goodwill 5 lakhs. Now whatever goodwill is bought by E needs to be divided among the partners in sacrificing ratio. So goodwill debit 5 lakhs to A's capital, to B's capital, to C's capital, to D's capital. This has to be divided in the sacrificing ratio, which is 2:1:1:6. That means it is going to be 1 lakh 50,000, 50,000 and 3 lakhs. Okay, that's pretty much on question number 23. Now let's move on to question number 24. P and Q are partners sharing profits and losses as 2:3. R and S are admitted and profit sharing ratio becomes 3:4:3:2. Goodwill is valued at 3 lakhs. R brings required goodwill and rupees 2 lakh cash for his capital. S brings rupees 1 lakh cash and motor vehicle for 80,000 as his capital, in addition to the required amount of goodwill in cash. Okay. Show the necessary journal entries. So we have two partners, existing partners here, P and Q. Their profit sharing ratio is 2:3. And they admitted two new partners, R and S. And after admission, their new profit sharing ratio is 3:4:3:2. Now the firm's goodwill, question says firm's goodwill is 3 lakhs. Okay, and R was admitted into this partnership and he is bringing 2 lakh rupees capital and required amount of goodwill, but it's not given in the question, so we need to find the goodwill amount. Then we have S also admitted into the partnership. He is bringing 1 lakh rupees as capital in cash, plus he is bringing motor vehicle of 80,000 towards capital. So there is cash and motor vehicle as capital. So his total capital is going to be 1,80,000 because there are two forms of capital. One is 1 lakh cash and 80,000 motor vehicle. Then he also brings goodwill, but it's not given in the question, so we need to find the goodwill of Mr. S. So first we are going to find R's goodwill. How we will find R's goodwill? The total goodwill of the firm is 3 lakhs. It's given in the question. 3 lakhs, and his share of profit is 3 plus 4 is 7, 7 plus 3 is 10, 10 plus 2 is 12. So his share of profit is 3 by 12. That is, his share of goodwill is 75,000. So we got the value of goodwill for R. It is 75,000. Now we need to find S goodwill. Total goodwill of the firm is 3 lakhs multiplied by his share of profit, which is 2 by 12. That is equal to 50,000. So his share of goodwill is 50,000. So we found the goodwill for each partners. Now we need to pass the journal entry. Okay. So we have all the details here. First thing is, for the journal entry, we need to understand how much money is coming into the bank account. So bank account, debit. So how much money is coming into the bank account? We have R bringing 2 lakh rupees as his capital and 75,000 as goodwill. That is 2,75,000. Then again, S is bringing cash of 1 lakh. So that is 3,75,000. And then 50,000 of goodwill also he is bringing. So that is 4,25,000. So total money coming into the bank is 4,25,000. Then apart from cash, S is bringing 80,000 as worth of motor vehicle. So a motor vehicle is there. So motor vehicle account debit 80,000. And one is R's capital, which is 2 lakhs. Then we have S capital, which is 1,80,000, 1 lakh cash plus 80,000 motor vehicle. Then we have to premium on goodwill, which is 75,000 plus 50,000. So that is 1,25,000. Right. Now we need to move this goodwill that we received to all partners in their sacrificing ratio. So goodwill account debit 1,25,000 to A's capital to sorry, it's not A, it's P's capital. And Q's capital. And how will we divide this goodwill? It has to be divided in the sacrificing ratio. So we need to find the sacrificing ratio now, right? Okay. So sacrificing ratio for P, it is his original share, which is 2 by 5 minus his new share, which is 3 by 12. that will give 9 by 60. For Q, his original share, which is 3 by 5 minus 4 by 12, that will give 16 by 60. So the sacrificing ratio between P and Q is 9:16. That means the goodwill, if we wanted to divide, it is 1,25,000 goodwill multiplied by 9 by 25. That is 45,000. And for Q, it's 1,25,000 multiplied by 16 by 25. That is 80,000. So we need to complete our journal entry, which is P's capital credit 45,000 and Q's capital credit 80,000. So we completed question number 24. Now we will move on to question number 25. Asha and Aditi are partners in a firm sharing profits and losses in the ratio of 3:2. They admit Raghav as a partner for 1/4 share in the profit of the firm. Raghav brings rupees 6 lakh as his capital and his share of goodwill in cash. Goodwill of the firm is to be valued at 2 years' purchase of average profits of the last 4 years. The profits of the firm during last 4 years are given below. The following additional information is also given. To cover management cost, an annual charge of rupees 56,250 should be made for the purpose of valuation of goodwill. The closing stock for the year ended 31st March 2017 was overvalued by 15,000. Pass necessary journal entries on Raghav's admission showing the working notes clearly. Okay, so let's do this. There are two partners, Asha and Aditi. Their profit sharing ratio is 3:2. They admitted a new partner, his name is Raghav. He is admitted for 1/4 share of profit and he brings rupees 60,000 as capital and his share of goodwill, but that is not given in the question. So we need to find this goodwill that Raghav should bring, for which the question says we need to calculate the goodwill. So they calculate the goodwill based on 2 years purchase of average profit for the last 4 years, and we need to find the average profit now. So we have last 4 years given, which is 2013-14, 2014-15, 2015-16, 2016-17. So they have also given the profit for each of these years. So first year it is 3,50,000. Second year it is 4,75,000. Third year it is 6,70,000. And last year it's 7,45,000. But apart from that, they have given also few adjustment. One is to cover management cost of an annual charge of rupees 56,250 should be made for the purpose of valuation of goodwill, which means that this management cost, we need to add this towards a cost for all these years that will bring down the profit, right? So there is management cost which will bring down the profit for all years. It is minus 56,250 minus 56,250 minus 56,250 and minus 56,250. Then the second adjustment says the closing stock for the year ended 31st March 2017 was overvalued by 15,000. If something is overvalued, it increases the profit. So by mistake it is overvalued, so there is an increased profit that is mentioned on 31st March 2017. So we need to reduce that much profit. So closing stock overvaluation, that is, we need to reduce our profit by 15,000. Now we need to find the adjusted profit. It is 2,93,750 in the first year, 4,18,750 in the second year, and 6,13,750 in the third year, and 6,73,750 in the last year. Now the question says we need to calculate goodwill on 2 years purchase of average profit for the last 4 years. So we need to find the average profit now. So average profit is equal to 2,93,750 plus 4,18,750 plus 6,13,750 plus 6,73,750. There are 4 years divided by 4, which is equal to 20 lakhs divided by 4, that is equal to 5 lakhs. Now goodwill is equal to 2 years purchase of average profit, which is 5 lakhs. That means goodwill is 10 lakhs. Now we have, this is the goodwill of the firm's goodwill. Now we need to find Raghav's goodwill, the new partner's goodwill. Raghav's goodwill is 10,000, which is 10 lakhs, which is firm's goodwill, into his share of profit, which is 1/4. That is equal to 2,50,000. So we found the missing piece here. So in our question, goodwill was not mentioned. We need to calculate it. So it is 2,50,000. So Raghav bought 60,000 as his share of capital, and then he bought 2,50,000 as his share of goodwill. Sorry, it's not 60,000, it's actually 6 lakhs. 6 lakhs as capital and 2,50,000 as goodwill. So the journal entry. Journal entry is, first one is cash account, cash or bank account debit to Raghav's capital to premium on goodwill. So Raghav's capital here is 6 lakhs and his share of goodwill is 2,50,000. So 6 lakhs plus 2,50,000, it's 8,50,000. That's the first journal entry. Second journal entry is this goodwill that is bought by Raghav has to be distributed to old partners in their sacrificing ratio to Asha's capital, to Adi's capital. Goodwill is 2,50,000. And what is the sacrificing ratio here? It's the same ratio, 3:2, which is 1,50,000 to Asha's capital and 1 lakh to Adi's capital. So we completed question number 25. Thank you for attending this module. Please subscribe to the channel so that you don't miss out on further questions.